The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The equity rally extends, but confidence in it narrows. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. You take a look at the S&P 500 right now, higher by about 0.5%, but then take a look at what's going on in the NASDAQ 100. That's where a lot of your big tech names live. We know that the party really starts for tech earnings tomorrow, but you can see the NASDAQ 100 higher by about 1% right now. I did want to pull up the dollar once again, declining. The Bloomberg Dollar Index down by about 0.7%. We're going to be keeping an eye on that. And then the small caps, they're not back to their winning ways necessarily, but they did manage to stem some of the bleeding that we've seen over the last couple days. The Russell 2000 higher by about 0.1%, Romaine.
Well, going back to the first two lines on the screen with the S&P and the NASDAQ, a fifth straight day of gains there, belying the fact, though, that breadth has actually flipped to negative, with the majority of the stocks in the red, a sign that the rally is narrowing, but just a bit. There's a refocus back on the relative safety of big tech stocks ahead of some big earnings this week. From that cohort, starting, and the party does start today, Katie Greifeld, with industrial chip maker Texas Instruments later tonight. And like pretty much every other daily rally that we've seen this year, when stocks are up by X%, gold has risen even higher, and the dollar has drifted even lower. So while risk appetite is present, it's hard to really characterize what's going on as risk on or even risk off. Maybe it just is what it is.
Yes, rising equity prices. Yes, risk on in one sense. And yes, low volatility, but historically very high uncertainty economically and geopolitically. People are trying to, they're just falling in love with a very old-fashioned solution to that problem.
Now, the tactical traders across assets feasting on this mixed direction right now. Case in point, you peep the 30-year bond yield here in the U.S., which flirted with 5% a week ago. Today, amid a broad-based sell-off in U.S. government debt, is ticking back up again towards that line in the Santa line. That's actually starting to attract some long-term investors looking to lock in what could be potentially the highest rates in a decade. And it's also attracting portfolio managers looking to hedge against a potential drop in equities from these record levels.
Well, let's talk a little bit more about what's going on along the curve, because you think about the 5s, 30s curve, it hasn't really been steepening all that much. It's sort of been treading water in a range if you take a look at the long-term exposure there. But then you take a look at exposure when it comes to some of these asset managers. This is data coming from JP Morgan. You can see that actually now bond funds are starting to favor a steeper curve. You can see that we dipped down into negative territory for that exposure in April all the way through July, and it's starting to build once again. And you can see where we stand just in the past month or so. We've seen a bit of an uptick, Romaine. So the steepener trade, it's been a little bit of a heartbreaker over the past couple of years, but it seems like some of those bond fund managers willing to step into the space once again and say this time maybe it really is different.
All right, well, let's talk to one of those bond fund managers. Kicking us off to the close here on this Tuesday afternoon is Brij Khurana. He's fixed income portfolio manager at Wellington Management. Brij, great to see you here.
Thanks for having me.
You look at that chart Katie Greifeld have.
Yeah.
Are you buying that or are you selling that?
So, I do think there's a lot of value at the long end of the U.S. bond curve, particularly in inflation-linked bonds. And so right now the market's pricing in what I would call a Goldilocks economic scenario. If you look at where 10-year real yields are, 10 years in the future, they're close to pricing at about 3.2%, which is basically the highest level since the early 2000s. And so, we do think that there's a lot of expectations that growth is going to continue and you're going to see this AI-led productivity boom. At the same time, there's not a lot of inflation expectations priced into the back end of the market. So what could change? Well, we do have a lot of fiscal stimulus for the next 6 months, but after that, fiscal spending is actually going to be contractionary. And then on the inflation side, well, maybe you are starting to see that reflationary theme pick its way into the market today. And so there's two ways to win when you buy long-dated inflation-linked bonds, and so we think it's an attractive part to be in.
I have to ask you, as a fixed income manager, how much are you paying attention right now to the softness in the dollar? And I don't mean just over the last few sessions here, but what at least seems to be the perception that the U.S. government seems to be actively rooting, if not sort of trying to manipulate a softer dollar.
So I do think, the administration can never say it's their policy, but I think they would welcome a weaker dollar, particularly against things like the yen and the Korean won. I think we have seen this reflationary movement since mid-December, and I would really ascribe it to three different things. One is what happened over the last Friday when the U.S. didn't intervene, but intimated that they might intervene in the DN. The second thing has been the emergence of Rick Rieder compared to Kevin Warsh. I think that is more, he's considered the more reflationary Fed chair, so his probability going up has increased that theme. And then the third thing, which the Fed doesn't want to talk about, but is really QE, and they don't call it QE because they're just replacing Treasury bills with reserves. At the same time, an expansion in the Fed's balance sheet, markets want to hedge that, and so they buy reflationary assets like gold, like stocks, like real estate. And so I think all three things are kind of creating this weaker dollar narrative, but also this reflationary narrative as well.
Let's talk about Rick Rieder from a few different angles here. First, I want to talk about the hedge effect when it comes to buying foreign bonds and then hedging that currency exposure. I was actually speaking to Rick Rieder at a Bloomberg event in December, and he said this is basically nirvana for debt fund managers who are taking a look at European bonds and buying in Europe's market. And when you think about that currency hedge effect, where are you finding the most attractive opportunities on a global level?
Yeah, so it is a really good point. I think as a U.S. investor, given different policy rates across the globe, you can find attractive yields outside of just what we have in U.S. fixed income markets. So, countries like Australia and New Zealand are actually pricing in hikes over the next 2 years, almost 100 basis points of hikes, while we're debating how much the Fed is going to cut. And what that means, though, is you can actually buy a New Zealand bond, for example, a 10-year AAA-rated bond, hedge it back to dollars so you don't take any currency risk, and that's yielding about 6% compared to, U.S. credit around 4.8%. So there's a lot of attractive opportunities if you're willing to kind of expand your remit and go more global in your bond selection.
Yeah, if you get a little bit creative there. Let's talk about Rick Rieder from another angle, and that is the race for Fed chair, because it seems like we're down to two candidates, Rick Rieder and Kevin Warsh. We're expecting a decision potentially in the coming days. I mean, again, as a fund manager here, how are you viewing this race? And you think about the two candidates on the line as they stand, how happy would you be with either?
So, I mean, obviously both extraordinarily qualified. I think it's really up to President Trump. What does he want to focus on? Lower short-term rates or lower long-end rates? And I think if you want lower short-term rates, it's probably, more Rick Rieder. And if you want lower long-term rates, it's going to be Warsh. And I think, when you think about what Rick has talked about, he believes we're in this AI productivity-led boom that is going to be disinflationary growth. And there's no need to have policy rates as high as they are because it is slowing down the housing investment cycle. Now, you go to Kevin Warsh, and he's much more focused on the balance sheet. And as I mentioned, I actually very much agree with him on the balance sheet that I do think it is reflationary. And so particularly when we have a K-shaped economy, when you reflate assets, it does, it does increase consumer spending and could make inflation much stickier. So point is that, you have more of a hawkish person in Kevin Warsh, which actually means less term premium and lower long-term yields compared to higher short-term yields.
On the balance sheet thing, though, I mean, given some of the geopolitical issues, particularly coming out of, the last few weeks of Trump on the world stage, I know no one is outside the U.S. necessarily dumping U.S. assets wholesale, but you've had a lot of talk, including from Katie Koch over at TCW, about this quiet quitting. Does this potentially force the hand of the Treasury and of the Fed, really, to actually buy more if you do start to see maybe a slight pullback by international buyers?
So, I think it's important to separate bonds versus stocks. Actually, in the bond world, most external holders of U.S. Treasury debt hedge the currency risk. So they don't want to take, because bonds are less volatile than currencies, so they typically want to get rid of that foreign exchange risk. What they don't hedge is actually U.S. stocks. And so because, the volatility on stocks is much higher than it is for bonds. And so what that means is if we are actually worried about the world selling U.S. assets, you're more likely to see that in the stock market than you are in the bond market. I think the fact that stocks are reaching new highs shows that it is actually not taking place right now. But I think it is more of a worry for the stock market than I do think for the bond market.
All right, Brij, great to have you here. Great insights. Brij Khurana is fixed income portfolio manager over at Wellington Management, kicking us off to the close. As we come back after the break, we're going to dive a little bit deeper into earnings out of LVMH, what we can discern from the luxury fashion market. Pauline Brown, the former chair of that company's North American division, going to be joining us in just a bit.
And then from fashion patterns to technology frameworks, a discussion on AI policy and regulation, or better yet, deregulation, with Alondra Nelson, a member of UN's advisory board on AI.
And we got a real treat coming up later. The renowned crime novelist Don Winslow is going to be joining us, fresh out of his sort of short retirement, where he waded into the areas of politics. A wide-ranging conversation with him a little bit later in the program. Stick with us. This is The Close on Bloomberg.
Well, Bitcoin and many altcoins breaking down since their October peak, and in their place, traders transitioning to prediction markets. Former CFTC Director of Enforcement Ian McGinley says, quote, "In many ways, prediction markets are the new crypto." Ian joins us now, currently a partner at Sidley Austin LLP. Ian, great to have you with us.
Thanks for having me.
Before we get into the enforcement of it all, let's just talk about that shift that you're seeing unfold, because you think about, what itch is scratched by crypto and what itch is scratched by prediction markets. I have to imagine that it's satisfying a lot of the same sort of excitement for those traders.
Right, and we've seen for a long time, really since the pandemic, the gamification of trading. And I think the rise of prediction markets is in line with that trend. And in some ways, for retail and really for all of us, prediction markets are a lot easier to understand, right? They're yes or no propositions on a future event. And they've exploded in popularity for a lot of reasons, but also because people really enjoy betting on real world events. When you think about the big snowfall that just happened, it used to be you'd go and you'd turn on the TV and take the word of your local weather man or woman. And now, friends of mine and myself, we would go on and look at the prediction markets to see what snow totals might be.
So it's really interesting. I think about, and this conversation, you could have had it with crypto a couple of years ago, whether or not crypto is going to grow up and become more like the stock market, whether or not prediction markets are going to grow up and become more like the stock markets. But it sort of feels that, it's more blending together than you might have expected. It's not necessarily the prediction markets maturing. It's just sort of everything blending together. Now you have a lot of stock exchanges considering, some actually pursuing 24/7 trading, for example.
That's right, and we've seen 24/7 trading in crypto, and it's been very popular with both retail and institutional investors now. I think what's really interesting with the rise of prediction markets is from mainstream to institutional adoption has been very quick. Right, for crypto, you could say it took time. We all knew about crypto; it was out there, it was gaining in popularity. But for the big financial institutions to get involved, that's been fairly recent. With prediction markets, I think it's fair to say in the last year they've really grown in public consciousness. And at the same time, you've seen, ICE, the parent company of the New York Stock Exchange, invest in a prediction market. We've seen other big venture capital firms get involved. So really a simultaneous growth in public demand, but also institutional interest.
I mean, how do you compare? When you look at the prediction markets as they stand right now, transparency, protection, true price discovery, the idea that if I'm participating, I know that the playing field is level. Does that exist?
Well, there's certainly that in prediction markets. I mean, when you talk about accuracy and looking at it, right, the 2024 election was a big use case for prediction markets, right? And that showed the president in the lead, much more pronounced than the polls did. In terms of integrity, every market, has similar issues, whether it's insider trading, market manipulation. There were a lot of stories recently about potential issues in trading in prediction markets. That's something I'm sure regulators are thinking about. Prediction markets are regulated. They have to register with the CFTC. And there's enforcement, particularly if there is any fraud or manipulation in those markets.
But as this expands, and I mean, you bring up the most recent presidential election, there were some issues raised about the most recent election cycle we had with some of the local races back in November, and the idea that it was skewing sort of the perception of maybe who was ahead or not. For example, there was a big billboard, I forgot which, if it was Kalshi or whoever had put it up here, showing, Mamdani at 80% versus, Cuomo at 20%. Now, that was the prediction market, but if you're walking by, your perception is, oh, that's a poll showing that he's up by 80 percentage points over the 20 percentage points. Is there any sort of talk amongst regulators, Al, about the way that these things are marketed, the way these things are presented so that it doesn't confuse the public as to what's actually being bet on?
Well, I'm not at a regulator anymore, so I can't speak to it. I think the problem, which is one that I think folks have long thought about with polls and with prediction markets, is if they're influenced by people who aren't placing a legitimate wager, but are actually trying to influence public consciousness as to who should be the favorite. If that's done with a bad intent, meaning you don't actually seek to trade with a counterparty, you seek to influence, that could be a problem. And there could be, potential civil enforcement by the CFTC and also...
By this CFTC? Well, I mean, they've pretty much taken a hands-off approach to this.
Well, we'll see. I mean, things take time, and when it comes to investigations, the current chair of the CFTC has made it, publicly said his agenda is to promote innovation, in crypto, in prediction markets. But he's also said there'll be no tolerance for fraud or manipulation.
All right, great to have you, Ian. Got to leave it there. Ian McGinley, partner over at Sidley Austin, former director of enforcement at the CFTC. When we come back, we're going to go back to the markets here and take a closer look at the performance of Starbucks. Their shares over the last 3 months ahead of a big earnings report and a big investor day coming up just over the next 48 hours. Stick with us. This is The Close on Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations, and we start off with Alphabet. Roth Capital upping its price target to $365 from $310, maintaining a buy, noting that events like the Winter Olympics, the World Cup, and the U.S. midterm elections will give the advertising company enough of a boost to offset some tougher comps in the second half of the year. Those shares up for a second straight day. Next up, Affirm. Needham upgrading the fintech company to buy and setting a price target of $100. The rating update comes in the wake of Affirm applying for a limited bank charter, a move the analyst says would be a game changer for the stock. Not today, though. The share is down for a third straight day. And finally, Target. Wolf Research boosting to pure perform ahead of the retailer's investor day on March 3rd. The analyst seeing signs that the company's underlying business is actually improving. Those shares higher slightly, but up for a second straight day. And those are some of our top calls. We do want to say in the consumer retail space, we're keeping a close eye on shares of Starbucks. They've actually, we're taking a look there at the 3-month performance. They are up about 10% over that stretch, just ahead of the coffee chain's earnings report scheduled for tomorrow morning. To fill us in on what to expect is Abby Roach, senior portfolio analyst over at Allspring Global Investments. All right, Abby, let's get to it. I mean, there's sort of the performance in the most recent quarter. There's obviously going to be a big focus here on some of the longer-term guidance. We may get that tomorrow. We may get that at the Investor Day on Thursday. But what are you expecting specifically out of that paper tomorrow morning?
Yeah, thank you so much for having me. I think tomorrow morning, we're hoping to get an update on the performance during the quarter. I think obviously with the Investor Day the next day, we think more of the focus around the longer-term expectations will be saved for Thursday. We think tomorrow we're hopeful that we'll get an update on some comp momentum. During the last quarterly call, they had given some positive news around underlying transaction growth for the U.S. specifically. And I think that's one area we're really focused on, seeing how the comps did in the U.S. and then specifically transaction momentum is really what the company has been looking for to see if their Back to Starbucks plan has been working. So we're really hopeful that we'll see some continued momentum there in the U.S. after they gave some positive commentary last quarter about September and October performance.
I am curious, too, just about the breakdown geographically, at least based on Bloomberg estimates of the various analyst estimates out there. Total comp sales growth roughly around 2% here. About 2%, 1.9 to be specifically, is in the U.S. Much greater growth, about 2.5% or so from their international businesses here. Do you see more of a right sizing of that going forward, where maybe the domestic business, the U.S. domestic business, starts to grow, if not on pace with the international business, but maybe even more?
We hope so. A lot of the focus and the discussion from management has come around the U.S. business specifically. I think when Brian Niccol started as the CEO, really he was emphasizing turning around the U.S. business. So our hope is that we're going to start to see continued momentum from the different initiatives that they've focused on in the U.S. business. And we think if they're doing their job well, comp transactions will continue to improve and that you'll start to see better performance in the U.S. business. The other thing, too, just on the comp ticket side of the business, they've introduced some innovation last quarter around protein specifically, which has been a very exciting area for consumers. So we're hopeful that maybe we'll get some info about a little bit of a boost to ticket as a result of some of that innovation that they introduced.
Yeah, Abby, I'm curious what you make about some of those innovations. Certainly, we talk about protein a lot on the close somehow. But, you mentioned that there is consumer excitement around protein in general. Do you think that that is translating into Starbucks lineup? You think about the protein lattes that they've introduced, the cold foams, for example.
Yes, I do. I think they did a good job of being able to innovate around the beverages to provide the protein that consumers are looking for. That's in a way that meets consumers' tastes. I think the one area where we've heard them discuss a little bit is around the food side of the business. And I hope to be able to hear more on sort of what they're doing in different items that they're rolling out. I think that's one area where maybe the news has been a little bit light on the protein side of things thus far.
And Abby, I'm curious as to who you see Starbucks competing with. Is it other chains such as a Dunkin' Donuts, for example, or is it really people brewing coffee at home and maybe trying to save some money instead of spending, more than $5 on a 16-ounce beverage like I did this morning?
Wow.
I think it's both, honestly. It's both those consumers who are, like you said, who are drinking coffee at home. Also, your traditional coffee companies like Dunkin' Donuts, but obviously, this is an area where there's a lot of growth for coffee, and we've heard a lot of different consumer companies either trying to kind of dip their toe into the coffee business or just roll out different beverages as it relates to energy or caffeine. So we think there's a lot of different innovation, a lot of competition in the space. They've got a lot of different players that they're trying to sort of fend off here.
I am curious, though, too. I mean, when you sort of look at what Brian Niccol has done since he took over, I mean, he's, at least publicly, there's been a lot of talk about the physical stores themselves, the idea of having people come in, sit there, the third space that Starbucks kind of used to be, or at least we perceived it to be. But when you look at their results, a huge portion of their sales are coming from, takeout. They're coming from drive-throughs. They're basically not coming from people sitting there. And I'm wondering, do they really need to lean further into this third space idea if the other parts of the business are doing so well?
I think they need to be able to do both. I do think, a lot of the things that they've been doing around the coffee house, in my opinion, have to do around improving the brand perception and around being able to balance those consumers who are wanting to spend time in the store and consume coffee or eat in the stores, but also those who just want to be able to pick up their food quickly. And I think you've seen a lot of the commentary around the coffee house, around the ceramic mugs and different rollouts that they're doing around the specific coffee houses. Mm-hmm. But also I think when you hear sort of the actions that they're taking around the order sequencing to try to improve the wait times for consumer, it's a bit of a balance of both, but it does feel like we've heard a little bit more on the side of different things that they're doing to try to improve the experience.
All right, Abby, gotta leave it there. Really appreciate your time. That is Abby Roach of Allspring Global Investments. We're talking luxury up next with Pauline Brown. Don't go anywhere. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on the U.S. equity markets, but we're also keeping an eye on shares of LVMH. They've sort of been whipsawing around all day. They seem to have settled for the moment, but we know that it was a pretty interesting report. There were a lot of peaks and valleys, so to speak.
Yeah, you take a look at the ADRs there. They are down about 1.5% traded here in the U.S. It gets to this idea, though, too. I mean, you're talking about a company, organic sales growth still with a negative sign in front of it. I think if you break out just the fashion division, that was even worse, down like 3%. And then if you break out the spirits and wine business, I think that was even worse, down 5%. So it kind of raises a lot of questions here about how they revive growth. And one thing that I just wanted to highlight here, too, was Bernard Arnault on the conference call with investors. And I thought this was good. He said, 2026 won't be simple either. But one thing at a time, it's hard to provide a serious forecast given the ever-changing nature of geopolitics and global economics. And there's sufficient reasons to be somewhat reserved this year.
Somewhat reserved.
Is that the French way of saying, oh, no?
Yeah, it's funny. I mean, and I'm sure a lot of CEOs across industries would agree with him that this is a really difficult year to forecast, especially when it comes to the luxury environment. So let's discuss now with Pauline Brown. She is former chair of LVMH North America and founder of the Aesthetic Intelligence Group. Pauline, it's great to have you with us. So let's talk about the different categories here. As Romaine mentioned, when you take a look at fashion, leather goods, that didn't look so great. But then you take a look, for example, at watches and jewelry, a bit of a bright spot here, reported sales increases of about 7 and 8%. What do you make of that mix? What does that say about the consumer?
First of all, it says less about the market than it does about the fact that LVMH has a very diversified portfolio. that where it saw some growth, particularly in watches and jewelry, is where it saw particular stagnation about a year earlier. So it was anniversarying off of a very soft comp. And the fact that the consumer, who is already showing a lot of reluctance to spend top dollar for fashion, recognizes the inherent value in very expensive watches and jewelry, simply because as investment pieces, they hold their own in a way that clothes, shoes, and bags do not. So the consumer is being rational, and LVMH is having to balance a pretty diversified portfolio, which has a lot of headwind, and any given time will have a little bit of tailwind as well, which is what we saw here.
I think that's so interesting, the point that, I mean, you think about jewelry, you think about watches. It sounds like you're saying that, you know, the luxury buyers looking at those pieces more as investments. Can you think of past periods where that has been true? Because there is that saying out there that, you know, luxury, it typically doesn't crack. It's not sort of as immune to some of the macroeconomic forces as other parts of retail. But still, this shift is interesting.
It is. It is. I mean, there's a few things that are happening that are making any historical comparison not quite relevant here. One of them is that the gap in pricing between very high-end fashion and very high-end watches and jewelry has closed. So it was always more expensive to buy a diamond necklace than it was to buy a nightgown or an evening gown. But if you look at the inflation that several of the brands and several of those within the LVMH portfolio have enjoyed in years where the consumer seemed pretty invincible and pretty price insensitive. And then they got to a point where the consumer said no more. And when it comes to watches and jewelry, they've been much more stable in how they've treated their prices, combined with the fact that the price of gold and some of the products that are going into those finished pieces are also have more perceived value today than they did just a few years ago.
Yeah, it'll be interesting to see whether they lean a little bit deeper into that. We do want to talk a little bit more about the fashion side of the business. But before we get to that, Pauline, I do have to ask you about the drinks, the spirits and wine part of the business. I mean, there was a great story in the Bloomberg terminal about how cognac makers, not just LVMH, but writ large, are basically sitting on huge amounts of inventory. You have farmers ripping out vines over there in France because they can't sell. I am curious, when you look at the drop that we've seen in sales of some of those products, specifically at LVMH, is that truly a function of what we're seeing when it comes to tariffs and geopolitics, or is this more of a long-term structural shift in consumption trends?
Yeah, it's both. It's both. The hardest challenge for LVMH when it comes to this segment is the fact that younger people are not drinking nearly at the level that they were just half generation ago. And time will tell whether they can ever get that back. I tend to think some of the sea change that we've seen toward non-alcoholic spirits, toward sober-free, sober, curious living, I tend to think we're not going to go back. And if that generation does go back, I don't know that they're going to go to champagne or cognac. So I think you have a consumer shift in terms of mentality and attitude toward the segment. And of course, you have the effect of the tariffs, and you have a pullback on high-end spending, especially from aspirational consumers. So you've got a lot of things coming together at the same time.
Yeah, and there's been a lot of talk, some investors saying that maybe they would be wise to maybe spin off that business. That's a conversation for another time, but I do want to get your thoughts on kind of the core fashion business. I mean, this is a company that some of its houses, it has new leadership to try to reinvigorate some of the legacy brands. I believe it finally kind of solidified its ownership, its full ownership of Loro Piana, which has actually been performing pretty well here. What is, if at all, any bright spot that you see in the fashion and the clothing side of this business?
Well, the brightest spot is not so much a spending one as I would say a marketing one. The fact that there are so many houses right now that have new buzzy designers, not just the ones within LVMH, but if you just take within LVMH, you have Dior, and you have some of the smaller brands like Celine. You have Fendi. You have, and they're all now being sort of infused with new energy, and that makes them editorially friendly. There's a lot of social media following. There's a lot more intersectionality between what we're seeing in Hollywood with the red carpet and what we're seeing at the shows as recently as this week in Paris. So we're certainly seeing a level of interest that I haven't seen for a couple of years. The real challenge is, does that convert into sales? And in most cases, it doesn't convert into sales of ready-to-wear. It'll more likely convert to sales of handbag, or in the case of Dior, into perfume, into lipstick. If it does not convert, these are very, very expensive marketing strategies that are not going to help that particular division, which is a very important one for LVMH, move forward. So that's something we probably won't know for a few quarters, but it's something that people will be watching very carefully.
Well, it is dizzying just to think about how many different brands fall under the LVMH umbrella, a well-diversified portfolio, if you will. I want to go to this line in your notes that, you know, when you're talking about LVMH's different advantages, you mentioned the diversification, but you also mentioned the Sephora hedge. Walk us through that a little bit.
Well, most people don't realize just how big a division it is. It's not as profitable as the others, in part because retail of third-party brands rarely is as profitable as vertical integration, but it is a big one. And unlike the others, it is truly a mass business. If you look at a Sephora shopper in the US, they're not that different than a Target shopper. They may spend differently at Sephora as opposed to even how they'd spend in the beauty aisle in Target, but it is every woman. So number one, from an economic standpoint, it's pretty diverse. And then number two, it skews much younger than many of the other divisions, particularly the wine and spirits and the watches and jewelry. Yeah. And so it's the one area of that group that they can still be relevant among a next generation.
Hey, Pauline, before we let you go, I do just have to get your thoughts here on the struggles going on right now with the Saks Empire, Saks Neiman Marcus, Bergdorf. Does this become a problem for LVMH and some of the other luxury brand houses that you have, at least for right now, what appears to be potentially the loss, or at least the erosion to a certain extent, of one of the bigger retail outlets for those brands?
Yeah, well, it's not good news, that's for sure. But if you look at the list of the top 10 vendors that are now creditors of a now bankrupt retail enterprise, LVMH is not at the top of the list. And part of the reason for that is that because they've had more leverage than some of the smaller players, that they've made sure, as long as they were selling to and through Saks and Neiman's, that they were getting paid in more reasonable timeframes. So the real crushing effect here is going to be on the small players, the ones that depended on wholesale for viability. For many, many years, well predating this bankruptcy, LVMH and some of the other larger ones have been going more and more direct in terms of opening their own stores. So the dependency is not as steeped as well. But when I say it's not good news because it's not good news for the consumer. The consumer really likes to shop in multi-brand environments as opposed to mono-brand. And they don't like to shop online for this particular category, particularly for ready-wear, or for shoes as well. People like to try things, to feel how it fits. They like to see it up close. They like to feel the leather on a bag. And so the industry still does depend on retail. Yeah. The consumer still depends on multi-brand. And let's hope for the American consumer and for the industry that Saks and Neiman's can pull through this.
All right, Pauline, we'll really appreciate you giving us your insights there. Pauline Brown is, of course, the former chair of LVMH's North American business, the author of Aesthetic Intelligence, and now the founder of the Aesthetic Intelligence Group. This is Bloomberg. Health insurance stocks tanking today. Humana having its worst day going back to 2009. This after the U.S. agency that helps to manage Medicare plans says don't expect a rate increase for what they pay to those companies. John Tozzi joining us right now to talk a little bit more about this. So let's get this right. Coming into 2026, they got a boost of roughly about 5%. The administration is floating the idea that for 2027, no increase at all?
Correct. That's what they proposed in the initial sort of rate increase for 2027 that was published yesterday afternoon after the close. That sent shares down across the sector. It was way below what Wall Street was expecting. They were looking for 5 to 6% increase. They basically got zero.
Yeah, pretty stark reaction, as you can see there. UNH actually reported this morning, yes. Correct? I mean, what could executives even say about that potentially flat rate?
Yeah, I mean, so they said they were disappointed. They said that it's not sufficient to cover medical costs. You know, insurers are saying medical costs are rising. You know, that's been going on for a few years. They've said that the level of funding in Medicare Advantage is insufficient to cover those increases, and a 0% increase from their perspective, will mean they have to cut more benefits for seniors.
And just for those folks who don't understand how Washington works, this is a proposal. It goes through a regulatory process.
Correct.
The flat rate that they are proposing right now, is it possible that that actually ends up being higher?
Yeah, and it typically does improve a little bit between what's proposed and then what's finalized around the beginning of April. How much that changes is still TBD, but you can bet that the industry is going to be lobbying hard for a bigger increase.
All right, John, great reporting as always. That is John Tozzi with Bloomberg News. Worth pointing out that healthcare is your worst performing sector on the day. We're going to take you to the closing bell next with Steve Sosnick. He is chief strategist over at Interactive Brokers. That conversation up next. This is The Close.
Heading into the closing bell for U.S. equities, and the biggest move is in the U.S. dollar at session lows, down more than 1%, having its worst intraday decline going back to mid-April. The president of the United States speaking on the ground in Iowa, saying that he isn't concerned about a decline in the dollar. He says, quote, "I don't think the dollar has declined too much," and says you can have it up or down like a yo-yo. Of course, Katie, a lot has been going on over the last few sessions and, quite frankly, the last couple of years when it comes to the value of the dollar, and a lot of speculation as to whether the White House actually wants this.
Yeah, I mean, especially in his first term, that was definitely sort of a stated intention that they would like a weaker currency. And President Trump also saying here, China, Japan always wanted to devalue currency. So sort of shifting it to some of the other actors in the currency market as well. You mentioned this is the biggest intraday decline for the dollar index since about mid-April. Already today, we were looking at the lowest level since 2022. This is a fourth straight day of decline. So this is part of a broader trend, but certainly that intraday decline for the dollar. You don't really see moves like that in the currency market, but they're becoming more and more frequent.
Yeah, particularly not with, the big dollar pairs.
Yeah.
I mean, they're not really supposed to move like that, but then there are a lot of things that aren't really supposed to be happening, and, well, here we are.
Here we are. It's a market reporter's dream, man.
It is, and to a certain extent, it's actually an investor's dream. Certainly, if you're a tactical one, a lot of opportunities out there, a lot of risk as well. Here to kind of break it all down for us and kind of find, where you land is Steve Sosnick. He's chief strategist over at Interactive Brokers. All right, Steve, I do want to start off with the dollar, and we could kind of fold that into how that affects equities. I mean, in general, the fundamental theory is a weaker dollar, obviously, to a certain extent, helps corporate earnings. But at some point, does a weaker dollar sort of work against what's happening here in the U.S. markets?
Yes, Romain. Clearly, if you're a multinational earning money abroad, you want to translate it into a more expensive currency, so that works well for you. Over time, though, you have to wonder: does this accelerate? The idea of the sell America trade. I have not been a believer that we've really been in a sell America trade. Instead, more it's a look for alternatives elsewhere type of trade. But when I see this happening, there's something going on with the moves in gold and silver, in non-precious metals, and this is not going to help. If you're a big importer, it doesn't really help your inflationary picture if you're the one with the weaker currency.
This gets to the idea, too, and I mean, you mentioned gold. There's been a lot of talk about the re-upping of the debasement trade. People are looking for a hedge against some of this volatility by flocking into hard assets. But people are still finding opportunity in U.S. equities, which are still, at least globally, still the most liquid and to a certain extent probably offer the best upside for growth. Are you a believer in that?
I do, but to a point. I think that there's certainly exceptional U.S. companies, but I think what people are discovering is there's a lot of value elsewhere in the world. We focus on 7 to 10 big U.S. companies on any given day, but there's thousands of companies out there, and many of them trade with more favorable valuations. They may not have the type of growth, but they also don't have the type of PEs or the type of multiples. So I think it's important to look elsewhere. I mean, I started my career in international equities, and so I've always had a foot in that world. And to me, the idea of just this U.S.-centric model doesn't really work when there's this whole big world out there.
Well, it is a big world out there, to your point. I mean, where are you seeing the opportunity, especially given that the international trade, I mean, we've been talking about it for well over a year now. We've seen well over a year of pretty decent performance. So where is there still room left to run?
I think in terms of international value is still a place to go. I think, a lot of these companies, particularly in Europe, are not the speediest growers, but they also they churn money. They have good market positions. They pay high dividends. It's not as exciting, but if you're getting a little bit of vertigo in these type of markets, it's a place to think of.
Well, speaking of excitement, I mean, we're just about to enter the heart of big tech earnings. You think about what we have in the days ahead in terms of the tech names, in terms of the Fed tomorrow. When it comes specifically to some of the big tech names that are reporting, how much will you be paying attention to sort of the CapEx story versus maybe some of the fundamentals?
I think you have to pay attention to both, but it's really going to be about guidance. I mean, we're in this wacky world where you're getting rewarded. The more you spend, the better you do. At some point, there is a little disconnect there. I mean, think about what happens with Meta, and I'm sure they're going to report some, giant spending number. Now, to be fair, if you own Corning, you just found out they're spending $6 billion with Corning.
Yeah.
By all means, that's fabulous. But in terms of the Meta story itself, what makes me a little nervous is how these stocks have run up into earnings. We saw it last week with Intel, which really ran up into earnings, and they didn't deliver. I think we're not looking at those kind of situations in these big mega cap techs, but it just raises the bar in how much guidance they need to offer, because my mantra is that an earnings beat is a necessary but not a sufficient condition for a post-earnings rally.
Yeah.
You now have to give guidance, because if 80% of the companies beat on EPS in any given quarter, that's just the benchmark.
Well, I mean, I'm glad you brought up Meta, which reports tomorrow. And of course, they got dinged 3 months ago when they basically said, yeah, we're going to keep spending like crazy. But then everyone asked them on the conference call, well, when's the return coming? And they couldn't articulate that. Does an articulation of that absolve that? Or is this sort of the situation where maybe the companies that are being a little bit more judicious in the AI rollout get rewarded?
It's a tough one, because somebody's going to be the winner, somebody's going to be the loser. They're not all going to be winners. The problem is, it's the Wayne Gretzky thing. You miss all the shots you don't take. So if you don't participate in it, I will tell you flat out, you're not going to be one of the great AI winners.
Yeah.
But
a hockey puck costs like $10.
Well, yeah, the hockey puck's a lot cheaper than a data center.
Yeah.
So yes, but the point being that I think ultimately we need to see rewards flow into the bottom line, and not just of the hyperscalers. We need to see it flow into the bottom line of the customers, because otherwise somebody's got to be making money off this, and it's not just the providers, and it's not just the chip makers, it's not just the data center people. It's got to be the end users. The internet did deliver on its promise, although, by the way, it took a lot longer than people thought.
Good point.
All right, Steve, before we let you go, we have to talk about the Fed tomorrow. Because, I mean, the point has been raised that Jerome Powell, he's a little bit of a lame duck Fed chair at this point. There's a lot more attention being paid to who is going to occupy the seat next. Is there still the potential that Jerome Powell moves markets tomorrow, especially in the presser?
There's always the potential, because I think because he has a unique perspective on what's going on within the committee level, who's dissenting, who's arguing, who's really in favor of policies that might perceive going forward. He might stick around too, so that's actually an interesting point. And I also put a non-zero probability on the fact that we're going to find out the new Fed chair sometime tomorrow afternoon.
Oh, really?
Because that's just the way things operate. I don't think that's the likelihood, but I think there's a non-zero possibility of that.
Non-zero possibility. That's exciting.
All right, Steve, always a pleasure. Steve Sosnick, Chief Strategist over at Interactive Brokers, counting us down to the closing bells. The outperformer in the equity markets today, that's the NASDAQ big cap tech. But the story as we head towards the close, Katie, is the dollar. The Bloomberg Dollar Spot Index off the lows of the day, but still down more than 1% here. A big flight into some of those havens. A big conversation coming up here with our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with a global simulcast. Carol Masser and Tim Stenovic join us right now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, as we await some earnings after the bell out of Texas Instruments and Seagate, with tech stocks leading the charge in equity markets. But the story heading into the close right now, a huge spike in gold and a huge plunge in the U.S. dollar.
Yeah, even before we see see, I'm just taking a look at the dollar index. It's now down about 1.3%. So definitely dropping on this headline from President Trump. Having said that, the greenback is really languishing at the bottom of the G10 currency pile this year, whether it's trade frictions, investor caution among an unpredictable White House, risks around Fed independence. There's been a lot of reasons why we've seen the dollar under pressure as of late, but taking another leg down on those comments by President Trump today.
But can we just say what those comments were?
Yeah, I have them right. Okay, so
Tim.
the president said the dollar is doing great. He doesn't think the dollar declined too much, and this is the one that got things moving. Trump isn't concerned about the decline in the dollar. He said you can have it up or down like a yo-yo. The dollar's seeking its own level, which is fair. China, Japan have always wanted to devalue currency, and that's when we saw the dollar tumble after the president said he's not concerned with its decline. He was making some comments in a diner in Iowa just before taking the stage. Yeah. He's speaking about affordability. He's scheduled to do that at 4 o'clock. And that's in Clive, Iowa, but he still hasn't taken the stage.
Yeah, and it gets to this idea, too. I mean, kind of saying the quiet part out loud. The market has been speculating really for months now that this was, to a certain extent, de facto U.S. policy, certainly within the Treasury, not necessarily at the Fed, although that could change with the new Fed chair. And now the president basically saying what a lot of us have already known for quite some time. Let's walk you through the equity market here. We did have an update here for the S&P and NASDAQ. I believe the S&P closing at a record high. Double check me on that, up about 28 points or 0.4% on the day. The NASDAQ up about 0.9%. The Dow Jones Industrial Average sitting this one out, a drop of about 0.8%. And the Russell 2000, which spent a portion of the day in the red, finishing higher by about 0.25 percentage point.
All right, that is an overview. Let's go back to the S&P 500. Kind of an even split. 234 names in the S&P 500 higher today. Katie, 269 to the downside.
You take a look at how the sectors performed today. You had 9 sectors in the green, 2 in the red. It was an update in the equity market, and I believe it was a record high. Romaine Bostick, big tech performing up by about 1.4%. Really interesting to see the beating that the healthcare sector took, down about 1.7%. Of course, the big news from yesterday after the close was that Medicare Advantage payment rates are going to rise by just 0.09% next year. That was certainly a surprise, and you can see that in some of these shares.
Yeah, we're getting earnings right now. Qorvo crossing the wire, and so too is Texas Instruments, a chip maker, but not necessarily the sexy ones that we like to talk about here. Industrials, automotives. The company appears to have missed on its fourth quarter EPS. For the fourth quarter, $1.27. The street was looking for $1.30. That's what it actually had posted a year ago. So a drop year over year and slightly below street estimates. Revenue did grow up about 10%, but just in line with estimates at about $4.42 billion. 14% growth in the analog business and about 8% growth in that embedded processing business as well. The shares oscillating between gains and losses, looks like right now up about 3% in the after hours trade.
Yeah, trying to decide what to do with that fourth quarter EPS miss. I will say that this is a stock that needed some good news. You think about how it's been performing over the past year or so, higher by just about 5%, 8% when you take a look at total return. That is far underperforming what we're seeing out of some of the other chip makers and what we're seeing in tech overall.
Not a lot of commentary from Haviv Alan, the chairman, president, and CEO of Texas Instruments, just calling out that revenue decreased 7% sequentially, but increased 10% from the same quarter a year ago. Over the past 12 months, we invested $3.9 billion in R&D and SG&A, invested $4.6 billion in CapEx, and returned $6.5 billion to owners.
Yeah, I'm just looking at free cash flow for the fourth quarter, $1.33 billion. That's up 65% year over year. So a big move there. R&D expenses are up about 6.1% year over year, coming in a little bit lighter. No, actually a little bit above what the street was expecting. So just keeping an eye on that one, still up about 3.3%. And it's actually up for the year. I think it's up about 9 or 10% already here in 2026. So looking to build on that gain remain.
Yeah, and just real quickly, I just want to check in on Qorvo, a much smaller cap company, but the share is down 11%, also in the chip space, more so for the mobile business here. The company saying that adjusted EPS did beat in this fiscal third quarter. It looks like adjusted revenue also beat here, but the guidance light, $775 million to $825 million. For the fiscal fourth quarter revenue, the street on average is looking for $904 million. Shares down about 10%.
All right, guys, let's go to some of the individual gainers. Just want to mention Corning, which at its highs was up 20% in today's session, finishing with a gain of about 16%. I think it's the number one gainer in the S&P 500 on this Tuesday. This after the company announced a multi-year up to $6 billion agreement with Meta Platforms to supply optical fiber cable and connectivity solutions for Meta's advanced data center, supporting its AI ambition. So an AI play, as we know there. Corning, by the way, CNBC pointing this out, which reported the deal initially earlier today, saying Corning is expanding its facility to cater to rising demand from the likes of Meta, NVIDIA, OpenAI, Google, Amazon, and Microsoft. And that stock has certainly been quite an outperformer in today's trading, I should say, or actually year to date. I'll get it there eventually. It does report earnings before the market open tomorrow. We are awaiting Seagate, which is expected to report any moment. It's the number 4 gainer in the S&P 500, a top performer in the S&P 500 last year. And you can see that name actually up about 4.5% in today's session. Analysts have been raising their price targets ahead of earnings today in the last few days. And today, Mizuho Securities raised the target on Seagate to 400 from 370, maintaining its outperform rating. And the stock is already up about 40% year to date. I don't think it's out yet, but it should be reporting shortly. And then HCA Healthcare up about 7% here at the close today, I believe to a record close in today's session. Shares gaining after the company reported better than expected guidance, easing investor concerns about expiring Affordable Care Act subsidiaries, or subsidies, I should say. And so that stock up about 7%. Katie, I think we have Seagate out.
We certainly do. Let's take a quick look at what's going on with Seagate, reporting that second quarter revenue came in at $2.83 billion. That is slightly ahead of estimates of $2.75 billion. For their adjusted EPS, that was a beat as well, coming in at $3.11 for the second quarter. The estimate had come in at $2.83. You can see the negative reaction there as well, looking for more detail, but have to imagine that comes down to the forecast, because taking a look at the second quarter results, certainly a lot of good news there.
Yeah, it's up 35% year to date. So a little bit of a decline on the day today with these earnings, down 3.2% after hours. Hey, speaking of stocks that are lower, let's take a look at some decliners today. Katie, you mentioned health insurance companies weighing on the trade today. We certainly saw that with United Healthcare, CVS, and Humana. United down 19.6%, CVS down 14%, Humana down more than 21%. This after the U.S. proposed holding payments to private Medicare plans flat next year. United Health sees first annual revenue drop in more than 30 years. Also, shares of JetBlue took a leg lower today. The company reported a wider loss than expected last quarter. It's challenging its strategy to win over high-paying customers. As far as the numbers go, adjusted loss of 49 cents per share, 3 cents worse than the average analyst estimate. Shares of JetBlue down 6.9% today. Operating revenue did come in slightly ahead of Wall Street expectations. And finally, shares of Pinterest fell today. The company's laying off less than 15% of its workforce. It plans to reduce office space as part of a global restructuring. Shares fell today by 9.6%. It does expect the actions to be completed by the end of the third quarter and sees about $35 to $45 million in pre-tax restructuring charges. Pinterest down 9.6%.
All right, we take a quick look at yields. A bit of divergence between the long end and the short end of the curve. 2-year yields dropping modestly by about 2 basis points here, but more activity on the longer end of the curve. You have the 10-year there, but we need to see that 30-year yield. The 30-year yield right now up 4 basis points to that 4.8 level and change. Here's some concern right now about the potential for it to get back up to that 5% level. Carol?
All right, that is a wrap, guys. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, we call it the closing bell. Romaine and Katie, of course, continuing there on the TV side, and Tim and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television across asset look, and a big focus right now on the dollar. The president speaking in Iowa just moments ago, basically saying that he seems to be comfortable with a weaker dollar. Joining us right now is Bloomberg FX and rates reporter Carter Johnson as we watch a dollar. Now, the Bloomberg Dollar Spot Index off the lows of the session, but still down about 1%. Was this saying the quiet part out loud?
Sure, Romaine, thank you. And it pretty much absolutely was. We came into today, especially after Friday, we saw a lot of action in the FX markets, particularly in dollar yen. We reported that the New York Fed, at the behest of the Treasury, was potentially involved in checking exchange rates with major banks. And then we came in Monday and today, and we're seeing dollar weakness continue. And then we just saw these remarks from the president, and that really gave traders a whole sort of new impetus and fire to keep selling. So that's what we're seeing now.
Yeah, it's interesting to note that, even before these latest comments from the president, the Bloomberg Dollar Index was looking at its lowest levels since 2022. You also had a great story out earlier today, certainly looking prescient, that even before these remarks, you had traders basically paying up to protect themselves against further losses when it comes to this dollar sell-off.
Absolutely, Katie, thank you. And I think that's something really great to mention as well. Our colleagues in London had a great story looking at basically how much does it cost to protect against more dollar weakness in the future. And right now, over the next week, that's the most expensive on record in Bloomberg data going back to 2011. So again, what that suggests is in the options market where traders look for optionality, look to hedge against tail risks, et cetera, it's really expensive to bet to hedge the dollar. Yeah. And that basically says people are pretty bearish right now.
I'm curious as to where that money is going. The FX market is basically a bear's trade, more or less. So if it's going out of the dollar, where's that money going?
Completely sure. So one interesting thing today, the Swiss franc really outperforming, classic haven. The yen, given everything we've been seeing the past few days, also outperforming. But what's really interesting is with this latest leg lower in the dollar right now, the euro and the pound, they're both trading at their strongest level since 2021. So we're seeing pretty concerted strength against G10 or among G10, among emerging markets as well, which are having a great stretch right now. So the short answer is it's pretty much going everywhere.
Pretty much going everywhere but the dollar. Carter, certainly it's going to be fascinating to chart this trade over the coming weeks and months. That is our Bloomberg FX rates reporter, Carter Johnson. Meanwhile, we do want to go back to those earnings that just crossed. When it comes to Texas Instruments, you can see traders trying to decide what to do, currently bidding up shares in the after hours. Let's bring in Jay Goldberg. He is senior analyst over at Seaport Research Partners. He joins us now. So, Jay, talk us through what you make of these results. You've had a couple of minutes to parse through them. You think about revenue, the forecast that they gave, the midpoint of that range is just ahead of analysts' expectations. What does that say about the picture for some of these analog chips and the demand there?
So Texan is a company that runs its stock deliberately boring. Like they want to be as boring as possible. So a little bit of a beat here is actually pretty significant. I don't want to overdo it, but it's good news, right? For Texan, $100 million over expectations is a good number. EPS also looked a little bit higher than consensus too. And I think what's taking place here is historically the analog stocks, Texan, ADI, NXP, are very tightly bound to the cycle, and we've been waiting because the others have already started seeing improvement. Texan seems to take a little bit longer to catch up with the cycle, and it looks from these numbers that they're finally catching the upswing of the cycle now. So I think people are excited about that.
It's interesting, Jay, because you think about some of the things that had been weighing on Texas Instruments, but some of the peers that you mentioned, there was a lot of concern about backlogs, whether or not inventory, customers basically being able to work through that. Can we extrapolate from these results that they finally have done so?
I think so. That's certainly my first blush conclusion. We'll see what they say on the call, but I think there are definitely signs that they're starting to convert. This is a company that's, been every quarter, it seems like they keep hitting record high inventories, and inventories are up a little bit here. Days inventory are up a little bit, but the sales numbers are starting to seem to be moving ahead a little bit faster than inventory for the first time in as long as I can remember. It's been a few years now where they've been building so much inventory, and hopefully that's topping out, and we'll start to see the improvement in revenue.
As we see, hopefully as these orders actually come through here, Jay, is there a sense here that there are alternatives for the buyers other than Texan right now, or is that more of a longer-term story?
I think that's a longer term story. One of the benefits that Texan and ADI in particular have is they sell most of the revenue goes direct to the customer. A lot of their peers sell 50, 60% through channel distributors, what have you. But the two big ones are mostly direct, and that gives them the ability to co-engineer with their customers and get really designed in for the long term. And so that should protect them, make that revenue more sticky over the long term. They have those customer relationships.
I am curious, too. I mean, I haven't gone completely through this release here, but when we talk about what's actually fueling the growth or what can continue fueling the growth, I'm thinking about the earnings we got out of General Motors this morning. Is this an automotive story, or is this more on the industrial side, or is it kind of a healthy mix of both?
We don't know yet. Their press releases are deliberately very, very light on detail. They'll give us some color on the call. I suspect it's pretty broad-based. Automotive, industrial, those have certainly turned up for their peers. And so hopefully TI is benefiting that as well. They're also probably seeing a lot of data center revenue as well. They, like every other semiconductor company, have a little bit of an AI story in there. And I suspect that's a pretty big number for them this quarter, too.
Yeah, absolutely. And, I'm taking a look at some of the other companies in your coverage. You cover a lot of the big ones when it comes to that data center story, Intel being one of them. I'm curious about what you make of Intel at this juncture. We were talking about, of course, the backstop that they have in the U.S. government having a stake. But you think about, the really extreme reaction that we saw to their results. It feels like the market not quite yet back in love with this name.
Yeah, Intel's sort of broke everyone's heart last week. If you go back 6 months ago, we were having a debate about whether or not the company would even survive. I think we're past that point. The government has taken a stake. NVIDIA's bought a stake. They're progressing, right? It's no longer an existential question facing them. Now it's just a question of, can they start doing well with the business? Can we talk about numbers rather than, surviving? And the numbers just aren't there yet. They have a good problem in that they have more demand than they have capacity for. They have a lot of this company's made a lot of mistakes over the last 10 years, and now it's sort of falling on Lip-Bu Tan and David Zinsner, the CEO and CFO, to turn it around. But they're having to clean up a lot of messes that have been sort of percolating there for a long time. And so we're not seeing it in numbers yet, but I think we'll start to see improvements to that as we move through the year. Yeah. Like I said, it's a good problem to have when you have more demand than your capacity can sustain.
All right, Jay, always great insights. Jay Goldberg, senior analyst over at Seaport Research Partners. Texas Instruments shares up about 5% in the after-hours trade as we await that conference call. Now, I said, of course, they don't really make the sexier kind of chips, but certainly ones that are very instrumental in our economy and to a certain extent now starting to be part of that data center and AI build-out. As we move closer into some of the earnings out of those AI companies, it's raising a lot of questions here about what the White House's AI agenda actually is. When we come back, we're going to speak with Alondra Nelson. She calls that policy a mirage of deregulation. She's a former White House deputy assistant. On that topic, she joins us next. This is The Close on Bloomberg. All right, tomorrow we're going to get earnings out of Meta, out of Microsoft, out of IBM, out of ServiceNow. And there's going to be a big discussion here about the spending on artificial intelligence. That CapEx build-out has largely been fueled, at least by the perception, of a hands-off approach by the White House. But our next guest calls that a mirage of deregulation. President Trump signed in an order to rein in state-level regulation. But Alondra Nelson, who's a former deputy assistant to President Biden, she argues the narrative of deregulation is misleading. She says, quote, systematic preference for executive discretion over deliberative process reveals an approach to governance that will shape AI policy regardless of how individual cases are decided. This is not deregulation in her words, not in the least. It is hyper-regulation by other means. Pleased to say Alondra joins us right now. She's a professor over at the Institute for Advanced Study and a member of the UN advisory body on AI. Very eloquent article you wrote there, Alondra, here about the state of regulation or maybe lack thereof. I am curious, though, because there are a lot of policy advisors in this administration, several of which come on this network and talk about the guardrails that they've put in place, the regulations that they have either enacted or at least advocated for. Why is that a mirage?
Well, it's a mirage because, the conversation is that it's deregulatory, that the conversation around Trump administration AI policy is that it is light touch. Light touch is used a lot. I guess what I'm trying to suggest is that it's actually quite heavy-handed. And in some instances, that's maybe okay. But, we need to actually kind of understand what the whole, spectrum of decision-making is happening here. And so on the, in a narrow sense, maybe it is the case that the Trump administration is not, encouraging its FTC to sort of really look at monopoly consolidation in the tech industry, for example. But it is the case that if you think, as your prior guest was just talking about, the United States taxpayer is the largest shareholder in Intel, right? The U.S. government took nearly a 10% stake in Intel in August. And, and we've also got, if you look at across the whole AI stack, nearly $10 billion of investment and lots of different companies and chips and semiconductors, critical minerals and rare earths, nuclear energy. So that whole supply chain, the U.S. federal government is really sort of having a hand in not only shaping, but also investing in. So, which is to say, we also often will say, we're great innovators because we don't have regulation. And it gives a lie to that equation, right? We are, to the extent that these companies are doing well, is it a bubble? Is it not a bubble?
Yeah.
In part, it's because the government is really in there steering these deals.
Well, I guess my question for you is not so much whether that's good or bad, but the idea, is there innovation? The Trump administration's argument would be, we're taking this approach because it allows for that innovation. Are we getting that?
Well, I think we're certainly getting a lot of valuation. So whether or not that looks like innovation remains to be seen. I think that's a long-term question. We're getting lots of new products. Today, I think OpenAI announced a new sort of AI for science product. So lots of things are shipping. I think that remains to be seen whether or not it's going to be innovation. We also have this question about whether or not it's innovation in the workspace, right? We saw last week, a few days ago at Davos, lots of questions about what it means for the labor market and whether or not automation, particularly if it's automation that's going to cast a lot of people out of work, is that innovation or is that just kind of dramatic, massive job loss on a scale that's going to create kind of social transformation that might be damaging. So I think I would say that the innovation question is a kind of long tail question. We can come back to it.
I do want to go back to what you were saying about Intel, because this is something that we've been talking about a lot. The fact that the U.S. government does have this stake in Intel. As you said, the U.S. taxpayer is a shareholder in Intel at this point. But it's interesting because that stake, the government stepping up and buying, I think it's 10% of Intel, as our guests have been saying, as you heard, has shifted the conversation on Intel away from being existential. It's no longer of a question of whether or not Intel will survive. So, I wonder how you think about that a company such as Intel, it might be on its last legs if it didn't have the support of the U.S. government.
So I think government, is always kind of trying to shape market. So, I served in the Biden administration. There was a sort of subsidy deal to Intel. So, we understood Intel to be a real champion in the American industry and I think worth saving. So, I think that saving it is, a good thing. I think the question when we become a literal stakeholder, when the American taxpayer is a stakeholder, it becomes a question about how do we get to decide, or how does the American public sort of have a role now in saying as a stakeholder, as an investor in this company, what's happening. And so I would say, that becomes really important when you look at some of the survey and polling data about the public's concerns about some of the AI use cases, right? And so is this shareholder piece, is this golden share even, this veto power in some of these other companies in the AI stack, when is that going to give the American public, I think, some say in how these companies are being steered? So I think I think that's the distinction I would make between the different ways that different administrations might choose to try to pick champions in an AI stack and a supply chain.
And I do want to talk a little bit about immigration, because you write that immigration policy provides another less visible lever of AI governance. Caught my eye, especially when you think about the news from this morning coming out of Texas, the government telling agencies to halt new H-1B visa petitions. You think about that push to put restriction on H-1B visas and other forms of high-skilled immigration. How does this fit into your framework of hyper-regulation?
Well, immigration, particularly H-1B immigration for highly skilled workers, is one of the reasons why the United States sort of leads the world in AI innovation and research and development. So, the question is then, immigration is a really important lever and driver of the AI industry. And so if you start to move that knob or move that lever, then you're making decisions about which perspectives, which expertise, what gets built, how it gets built. And I think, on top of the Texas news, I'll just remind the audience that President Trump said several months ago that we're now going to start charging $100,000 for each H-1B visa. So, if you think about companies that are trying to, move forward in this space and have high-skilled workers from around the world, which is how, U.S. Industry has sort of advanced for generations now. When you have, $100,000 towards, 20x, 30x, 100 employees, I mean, that then becomes real money. And that becomes, I think, when you're really sort of having a heavy hand and intervening in how companies are giving shape to the work that they're trying to do. So in addition to the kind of on the ground immigration politics that we're dealing with in the United States, that's been quite tragic, there's also this kind of, bigger, almost existential question about how we keep this ecosystem going.
All right, Alondra, got to leave it there. Some really interesting food for thought as we head into big tech earnings. That is Alondra Nelson. She is Harold F. Linder Professor at the Institute for Advanced Study. Meanwhile, we do have some breaking news coming out that the U.S. is selecting the next round of drugs for price negotiations. On that list remain Botox to face negotiations for price cuts in 2028.
Yeah, also Biktarvy is on there as well, which believes is a HIV-related drug here. There might be some more here. This is just crossing the wire, so it's going to take some time to parse it. But of course, you have the President of the United States right now in Iowa set to take the stage, presumably, ostensibly, a speech that is about affordability. He has found a renewed interest in this, of course, heading into a midterm election season.
Yeah, and we've certainly already heard a lot from him today. He's certainly moved markets a lot today, especially when it comes to the currency markets. You think about the effect in the dollar, of course. It's going to be interesting to hear what else he has to say when he does finally take that stage.
We're going to get you some more details on that drug pricing. And of course, we will fill you in as soon as we hear from the President of the United States and any potentially market-moving things that he has to say. When we come back, Libby Cantrill will be joining us, Pimco's head of public policy. Stick with us. This is The Close on Bloomberg.
Well, as we mentioned before the break, President Trump expected to speak any moment now at a rally in Iowa, focusing in on affordability and on the economy. Now, as we await those remarks, let's bring in Libby Cantrill. She is Pimco Managing Director and Head of Public Policy to discuss. And Libby, I actually want to start with what we heard from the president in a diner in Iowa a little while ago, starting with the U.S. dollar. He said that he is not concerned with the decline that we've seen in the dollar so far, saying it's doing great, also calling out Japan, China for allegedly devaluing their currencies. I just want to hear your thoughts on what the state of the U.S. strong dollar policy is. Does it still exist?
Yes, well, nice to be with you. I mean, yeah, absolutely. Do we think it still exists? I mean, Secretary Bessent has talked about the strong dollar policy. President Trump, early on in the administration, talked about tariffing countries that he thought might be selling the dollar in order to weaken the dollar. So I think that this needs to be sort of put into context. Of course, the dollar has declined. Last year it's declined over the last few weeks, starting in 2026, but it's still relatively strong. If you look at sort of, from a historical perspective, obviously a lot of our clients still have a big U.S. dollar asset overweight, and our folks, diversifying away from that kind of incrementally, sure. But is this like a big referendum against the dollar? We don't think so.
Yeah, it's interesting. I mean, you think about where the Bloomberg Dollar Index is right now. It's at its lowest level since 2022. You take it out on a 10-year average. It is sitting just below its 10-year average, but pretty dang close. You mentioned, some of the dollar positions that your clients have. There is the concern that, you have Trump making these comments about the dollar and basically putting a green stamp when it comes to the sell America trade. I mean, where are you thinking when it comes to whether or not that actually has legs?
Well, yeah, I mean, I think there's the reality, which is that the U.S. Treasuries market is the deepest, most liquid bond market in the world. The U.S. economy is the most dynamic and I think arguably most innovative economy in the world. So yeah, I think there is a sort of a limit from an economic perspective to this sort of sell America trade. But obviously, politics, in some ways, the political tail is wagging the kind of the economic dog, at least temporarily, where folks are kind of making decisions out of kind of economic nationalism or kind of political motivation. So again, I think we have a more nuanced view. Our view is that the dollar still remains dominant, still remains the so-called reserve currency, but also that there are plenty of opportunities outside of the U.S., both in developed markets, but then also in high quality emerging market, both FX and the rates market. So again, we have a more nuanced view.
So, Libby, I do want to get your thoughts on what's going on in Washington, specifically in the here and now, the idea of a potential government shutdown, and whether that is a realistic option right now. Obviously, this will depend a lot on just how much of a spine the Democrats have, if they have any left at all. But it gets to this idea of why are we going through this again? I felt like we just went through this, 2 months ago?
Yeah, of course, we had the longest government shutdown in history several months ago as Democrats tried to draw attention to the expiring Affordable Care Act expanded subsidies, which now have, of course, expired. And I think, I think the view in the Democratic caucus is that they don't like shutdowns. I don't think that's necessarily changed. But there's also sort of a political motivation here that they are kind of willing to draw attention to, of course, what happened over the weekend, what happened, Renee Good, several weeks ago, and also in Minneapolis. So I think that there's, a strong view, some consensus that things have to change, that there's a political benefit of drawing attention to this. But there's also, I think, a substantive argument to be made that they can try to extract some concessions from the administration to try to, increase some accountability around some of these immigration raids that have been taking place.
Yeah, well, I do want to talk about that, specifically, though, in the context of what the White House is trying to message. We kind of came into this year, and I mean, he campaigned on the idea of closing the borders, cracking down on immigration. If you're a supporter of that, I think objectively you can say that is a success for him. And to a certain extent, it appeared that he was trying to carry that into the midterm elections. There seems to be now a bit of a shift, at least some jawboning, on this idea of switching more to affordability. And I am curious as to whether what has transpired over the last couple of weeks with the extrajudicial killings of 2 American citizens in Minnesota as part of that immigration crackdown are going to overshadow any attempt to pivot to more material things like the economy and affordability.
Yeah, I mean, I think all of those things you've just said, of course, are correct. I mean, immigration has been actually one of the issues where he has been quite differentiated in terms of polling. People, Republicans mostly, but also independents and even some Democrats have been, by and large, kind of more supportive of some of the things he's doing on the immigration front up until really the beginning of this year, right? And so that's kind of starting to soften. And then the economy and inflation, cost of living, those have been, like they were for President Biden, honestly, kind of liabilities for the president. And so there was this view, let's lean into our strength, but also try to kind of play defense on our weaknesses. But now, again, immigration's becoming a little bit more of a liability as well. Yeah. I think the broader point that you bring up, though, is a good one, which is, and we're going to hear it from this speech, we've seen it with some of these policy announcements, that the president understands that affordability is a huge political issue for him and for Republicans, and that they're going to try to lean into this sort of affordability agenda.
But will there be follow-through? I mean, it's one thing to say it. I mean, the immigration crackdown has been aggressive. Are we going to see that type of aggressiveness in addressing affordability?
Well, this is where, honestly, the rhetoric and the reality are quite different, only because the sort of the tools that the president have is kind of limited in terms of what he can actually do around affordability. Much of it has to go through the Congress. So, for instance, a prohibition of institutional investors buying single-family homes. That has to be legislated. He doesn't have the power to do that. The cap on credit cards also has to be legislated. No current law gives the executive branch the authority to do that. So I think there are some limitations just in terms of, to your point about follow through, not because he doesn't necessarily want to, but because there are some limits to what the executive branch can do. One thing though they can do, and we've been sort of telling our clients this before they started doing it, and they've now followed through, is that they can direct, or he can direct Fannie and Freddie to buy more agency mortgages. They have a lot of balance sheet capacity. We think they will continue to lean into that. That's good for agency MBS, for those portfolios that have it. In our case, many of them, we're kind of strongly overweight agency MBS. But we think this is something where he will lean into it. And it's something they can do it unilaterally, and also has a big impact, right? Mortgage rates have rallied 20, 25 basis points since CNC announced it.
Well, I do want to go back to some of the proposals that you mentioned when it comes to being against institutions buying single-family homes, the cap on credit card interest rates. As you said, I mean, those aren't unilateral actions. That has to go through Congress. But to the voter who is voting in the midterm elections, does it matter? I mean, you think about the soundbite saying that you're against Blackstone buying up, homes in your neighborhoods. That's a great soundbite. Do voters care necessarily if they see the impact by November, or is it just the messaging?
Well, I think it's a little bit of both, right? I think this populist rhetoric clearly works. I mean, you've seen it on the right. You've also seen it on the left, right? There are many folks who are also running for public office on the left who are also saying things that maybe they can't actually effectuate, but sort of sound good, right? They sort of fit into the sort of the zeitgeist of the voter. I do think that what people, by and large, though, they vote kitchen table issues. They vote how they're feeling. This is one of the reasons why, arguably, President Biden and Kamala Harris lost, and it's also, of course, one of the reasons why there's some softness in President Trump's polling. I think something that Republicans are really hoping is that these refunds that they will be getting, that voters will be getting, $1,000 to $2,000 on average for a household, as part of the One Big Beautiful Bill, will hopefully, soften some of that, that negative sentiment that will hopefully sort of shore that up. So I do think it's both. The messaging certainly matters some, but really how the reality matters even more. And I think Republicans are hoping that with these big refunds, they'll be able to at least fill in some of that gap in terms of the weakness on the economy.
Libby, always a pleasure. Great insights as always. Libby Cantrill, Pimco's managing director and head of public policy, as we await, of course, that speech by President Trump, a rally, if you will, in Clive, Iowa, just there west of Des Moines. Katie?
Let's take a look at some of the notable after-hours movers here, because it is earnings season. We're waiting for the big guys tomorrow when it comes to the Magnificent Seven, but we do have a few earnings up on the board right now. You can see that Texas Instruments is your lone rallier, up by about 7% after hours. Can't say the same for Seagate or packaging as well. Corvo also down in the dumps. This is the close on Bloomberg.
All right, for those of you who are avid readers, particularly in the genre of crime, our next guest won't disappoint. His novels, international bestsellers, really splashing on the scene years ago with Power of the Dog, and many have been or are actively being developed into projects for the big screen. And his latest novel is just released today. It's called The Final Score, and in about 2 or 3 weeks' time, a new Amazon film debuts based off one of his previous novels, Crime 101. Pleased to welcome to the stage here is acclaimed crime novelist Don Winslow. Don, great to have you here on the program. I do want to start off first with the Amazon film. Pretty interesting lineup of folks. You got Chris Hemsworth, Halle Berry, Mark Ruffalo, kind of just an interesting cast of characters. Talk to me here about the process of getting this from book to film and the idea of why it ended up on Amazon and not elsewhere.
Well, listen, the process is interesting. It was fun. My agent, Shane Salerno, represented the book. Bart Layton director and screenwriter, got very interested in it, and then it went to MGM Amazon. So it'll actually open in theaters on February 13th and then stream on Amazon afterwards. This is the way that films are done now, and I'm very excited about it.
Well, that's what I was curious. I was kind of getting at, because obviously there's been a lot of debate here about the release of films, whether they should go straight to streaming, whether they start in theaters, how long they stay in theaters, and of course with the potential sale of Warner Brothers Discovery, the complete kind of re-upping, if you will, of, I guess, the traditional movie studio space here. You've been in that ecosystem for a while to a certain extent. Has it actually improved things? Has it made things harder as a creative?
No, listen, I think the creative process is always the same, at least for people like me. You know, you try to write a good book, you try to tell good stories with good characters. And from time to time, the platform for that changes. But I think that the basics of it never change.
I am curious, where you look to inspiration. I mean, you've had 8 crime fiction books. All of them were New York Times bestsellers. And when it comes to character creation, I mean, what is the process there? Do you draw on that from people that you've met in real life, or do you go inside?
Boy, it varies from book to book. You know, I wrote 3 books, for instance, about the Mexican drug cartels that were very, very close to reality. So I was inspired by those characters, and sticking pretty close to the bone. Other characters, such as the film you're about to see, was totally imaginative. It sounds a little airy-fairy, but sometimes characters just start talking to you. They have their own ideas, and then I try to get that down on paper, or I guess, on screen these days, and go from there.
And so, of course, your latest book, The Final Score, it comes out today, which might be surprising, to those who were following you a couple of years ago when you announced your retirement from fiction. Your plan was to focus on political activism. Talk to us about the decision to basically come out of retirement.
Well, I did stop. I did focus on political activism for a year or so. And then, I thought, well, I'm retired. But then these stories and this book just kept coming back to me and back to me and back to me, demanding to be written. And so I finally gave in and sat down and wrote it. And I'm glad I did.
I am curious, though, too, when we talk about kind of your development of characters, the dialogue, which you're very well known for, I am curious just how close that hews to reality. And I kind of ask that, too, in the context of some of the things we've been talking about in the real world with the crackdown, ostensibly, of drug cartels in Latin America. Is that a real reflection of what's really been going on over the last few decades in some of those countries?
Listen, I think the war on drugs has been a massive failure over many decades. You are never going to solve the problem of drugs on the supply side. It's not doable. You can only really address it on the demand side. If there's no buyer, there's no seller. It's that simple. But there are a lot of buyers, both here and in Europe and elsewhere. And so the cartels are going to survive in one form or another as long as there's that demand.
Well, that's what I'm curious about, too, because we talk about the fight against it. And I guess I think we all agree there certainly has to be a fight. But has that fight been misplaced? I mean, I am sort of a product of the, Just Say No era of Nancy Reagan. Sure. And, of course, and obviously what her husband did with regards to his fight against the cartels. I don't want to be too flippant about this, but, it doesn't seem like a whole lot has changed. I mean, there are just as many drugs flowing, certainly through New York City, as there were back in my childhood in the Midwest and Chicago. So what's changed, if at all? Have things actually gotten better on that front?
No, things have gotten worse. If you look at the statistics now, drugs are more plentiful, more profitable, more powerful, and cheaper on the streets than they've ever been. So if that's winning a war, I would hate to see what losing a war looks like.
So the war on drugs, clearly a source of inspiration for you. When you take a look around the world today, and there's plenty to pick from, I mean, do you see any inspiration there for future books, future characters?
I'm always on the hunt for future characters and for future books. And there's so much out there that's an inspiration. So we'll just have to see.
Oh, sorry, Don. And so I just want to kind of bring this home before we wrap up here with the release of the film. And I haven't had a chance to see it here. It's basically a heist film, which is one of my favorites here. When we talk about why does L.A. always seem to be the backdrop for these heists. Of course, probably one of the greatest heist films, certainly of the modern era, in the U.S. that's based in the U.S. is, of course, Heat. But I am curious as to why so many of these films seem to be based in L.A. Is it just easier to steal things in L.A.?
I don't think it's easier to steal things in LA, but it might be easier to shoot things in LA. And by shooting, certainly I mean film. Listen, it's the home of the film industry, the worldwide film industry. And so it's easier to shoot in LA because people can live at home, actors and staff, and stay at home. But it's also just an extremely photogenic city. You know, I'm sitting in it now with the palm trees, the ocean, the great streets, the buildings downtown, and the variety. It's extremely photogenic, and so it works in these films. And of course, you mentioned Heat, one of the greatest films of all time.
Yeah, and not to be, to not give flowers to Rififi, of course, also one of the greatest, not set in L.A., but also one of the greatest heist films as well. So what's next for you, Don? I mean, what comes after this?
I don't know. I'm not being coy. I really don't know. You know, I think I'll always write. I know I'll always write. I do it every day. I can't seem to help myself. Whether I'll publish or what that will look like in the future, at this point in time, I just don't know. You know, I'm just going to take in this moment and enjoy it, and then we'll see what happens.
Well, Don, we're certainly excited to see where you go next. Congratulations, though, on this moment. That is Don Winslow. He is the author of the newly released book, The Final Score. Meanwhile, let's go quickly back to Texas Instruments, now extending their after-hours gains to 10%. Sort of a muted reaction here to the numbers that we saw come out at the top of the hour here. A solid outlook, that is sort of the way that the street is phrasing this, and it seems like investors agree. Yeah, and I think some of this also has to be a function of what some of the commentary that's coming on the conference call with executives really talking about how the value of inventory did decline. They said they're nearer the end of this elevated CapEx cycle and say that they actually see a lot more room to grow in that industrial segment, of course, a core part of their business. Also says the new data center division in and of itself is up about 70% here. So all in all, a pretty good time. And I was just trying to go back, Katie, and look at the last time the shares actually moved at that magnitude. I mean, if this holds into the cash session, this would certainly be one of the bigger days, certainly post-earning days for this company in quite some time. Yeah, I'm excited to see, too, what this portends maybe for some of their peers. We were having this conversation with Jay Goldberg that when it comes to some of these analog chip makers, it's sort of been not a great environment. NXP reports, I believe, February 3rd. You take a look at shares right now. Initially, they did pop in reaction to these earnings, now unchanged, but we'll see how things open up tomorrow. And we should point out analog devices also in that space. They're up about 4% in the after hours trade. So it'll be interesting when we come back tomorrow in the session because, of course, not only could this set the tone, but of course, we know after the bell, we get a read on kind of the AI spend from the other end, not the chips, but of course, a lot of the software companies and I don't know, what do we call Meta? I mean, they're an advertising company. But I'm already tired thinking about the show tomorrow. It's and then there's Tesla, too, is in there, too, Tesla. Which I don't know. Are they a car company? Are they an AI company? Are they robotics? What are they? Well, Elon Musk would tell you that it's an AI company. Yeah. So, and probably the valuation would as well. Well, we'll see if those valuations hold up. Of course, all of that will be here right on the close. We're going to set you up for what to actually keep an eye on over the next 24 hours when we come back. So stick with us. This is Bloomberg. All right, a lot going on here on this Tuesday. Wednesday promises to be even busier. A slew of earnings scheduled for tomorrow, and that includes in the morning, Katie Greifeld, a couple of key ones there. Starbucks, AT&T, GE Vernova taking the stage before the bell. GE Vernova, that could be interesting. Yeah, absolutely. It's going to get even more interesting after the bell, though, Romaine. Buckle up. We have Meta, Microsoft, Tesla, IBM, Lam Research, and ServiceNow. Wow. And this gets to this idea here of kind of what's really been driving this market. Obviously, all of these kind of linked to some degree or another to the AI trade. But I don't know if you forgot, Katie Reifeld, before we get there, apparently there's a big event at 2 p.m. with Jay Powell. Oh, big time. Yeah. We're going to hear from Jerome Powell. Well, we'll get the decision at 2, and then hear from the Fed chair himself at 2:30 p.m. It's going to be interesting to see the knee-jerk reaction to the decision itself, and then maybe, of course, what happens during the presser. Yeah, no one expecting a change in rates, but of course, that press conference could be a little bit spicy. Our coverage starts at 1:30 p.m. Eastern with team surveillance taking the helm. But stick around. Later tonight, Balance of Power is coming up at the top of the hour.